Hello, everybody. It is my pleasure to welcome you at our workshop. I will give the word to Petr Jansky from Corptex to give us a brief introduction before we get to our two sessions. Hello, everybody. It is my pleasure.
Thank you, Mirek, and welcome to everybody to the workshop on multinationals, organized by our research group Corptex at Charles University in Prague and our friends at the EU Tax Observatory. With our excellent contributors, we are happy to present some of the recent research on some of the most important issues related to taxing multinationals. In the first session, we'll focus on the policy response to profit shifting by multinational corporations. In particular, we'll focus on global minimum taxation. And in the three papers that we will hear about, we'll hear lessons from economic theory, from a careful evaluation using the best available data, and lessons from the United States reform that implemented its own version of global minimum taxation a few years ago. In the second session, we will go beyond the scale of profit shifting. And in the three papers, we'll hear about its implications for inequality. We'll hear about the development over time. And last but not least, we'll hear about its fiscal consequences, in particular for the tax structure of affected countries. Before we proceed, let me share a few words of thanks. Thanks to my colleagues at both the EU Tax Observatory and the Corptex. In particular, Miroslav Plansky and Sarah Godard, who will be moderating our today's workshop. Let me briefly say that we're keen on expanding our team, and Corptex is currently hiring new PhD candidates. So if this sounds interesting to you or to some people you might know, please spread the word. And last but not least, thanks to our speakers and discussants who have accepted our invitation. Thank you. And I don't want to delay you any further from the workshop itself. So over to you, Mirek.
Thank you, Petr. So in our first session, we will hear three speakers and just a bit of housekeeping before we start. So we will have 15 minutes for each presentation. Each speaker will share their slides, and please will keep comments and questions to the chat system because we're quite numerous. So you can either comment in the chat here on Zoom, or if you're watching via YouTube, you can comment on there as well. And we will be monitoring the chat and then moderating the discussion, which will follow after the three presentations that we have. And we will first hear comments by Nadine Riedel that will open the discussion, and then we will go to the questions from the audience. So our first speaker is Niels Johannessen from the University of Copenhagen. Welcome, Niels. I hope everything is okay, and please go ahead, and the floor is yours.
Thank you very much. Can you hear me, and can you see my slides?
Yes.
Great. Okay. Well, thanks very much for including this paper on the program. I'm very excited to present it to you and to also hear Nadine and others' comments. So the title of the talk is The Global Minimum Tax. And so like the starting point, of course, is this like ambitious reform decided in October 2021 that included various aspects, but also this famous global minimum tax of 15%. So the goal here is really ambitious. It is like we want to fix the global corporate tax system by doing a number of things. So we are interested in curbing profit shifting to tax havens, because that is kind of eroding our tax bases in high tax countries. And we also want to stop, or at least limit, like the race to the bottom in corporate tax rates. And the key mechanism here, like at least when we're talking the Pillar 2 and the global minimum tax, is like this new type of top-up taxes that are imposed in the home countries of multinational firms. And just like very briefly, the way it works is the following. So if you imagine that Google nowadays has some profits that is booked in Bermuda and they're taxed at 1%, with this new reform, we're saying, well, the aim is to have a minimum tax of 15% on all profits. So the US, which is the home country of Google, will now impose a 14% top-up tax on those profits. So bringing the global taxation of these profits up to 15%. So in this paper, I'm asking, how should we think this reform will affect welfare in countries that I call non-havens, so countries like the US, Germany, and France, so countries that have normal corporate tax systems and are not havens. They don't really compete for other countries' profits. The method that I'm going to employ is to develop a theoretical model of international tax competition that has heterogeneous countries. So it specifically, it includes both havens and non-havens. And here, so I'm going to first try to find the global policy equilibrium, both with and without a global minimum tax. I'm really going to say, how does this reform, how should we think that it will affect the policy equilibrium? And then I'm going to perform a simple welfare analysis and say, with these policy changes, both at the global level and at national levels, how does welfare change in places that are non-havens? And the idea is really to say, well, there are people out there now, we're going to hear some of this analysis later, that try to say something empirical about the welfare effects or the effects of these reforms based on the current distribution of profits globally and kind of current policies in tax havens and also non-havens. And I think the most general point I want to make is that we have to be a little bit careful with these things, because not only should we expect firms to, of course, change their behavior when we shock the global tax system like we do with the global minimum tax, but also we should imagine that countries will re-optimize their tax policies in light of this new global tax environment. And so this is a first attempt at really trying to say, let's try to endogenize firm behavior, let's try to endogenize policy behavior and see what comes out of what happens to welfare in this new equilibrium after we introduce the global minimum tax. So the main result is a little bit discouraging, perhaps. So I think that the global minimum tax has been really celebrated and well received, and people tend to think that this is this is really a good thing, for the world and for high tax countries. I'm showing here that that is not necessarily the case. That actually there are kind of counterbalancing forces, and that actually the net effect might be negative from the perspective of non-havens, notably if the rate at which we introduce the global minimum tax is low. I can't put a number of that, but just if you have a low rate, then the risk that you will end up with something worse than before is bigger. So let me just put some, so try to explain a little bit what's going on in the paper. So basically what happens is in the model that when there is no global minimum tax, we will have tax havens competing for profits, and in the equilibrium, they'll all end up setting a tax rate equal to 0. Why? If they set a tax rate above 0, they'll receive no profits from multinational firms. They only shift to where the tax rate is lowest. Once we introduce a global minimum tax, this is going to create a floor under the tax competition in havens. So in the new equilibrium, all havens will end up setting a tax rate exactly at this global minimum level that I call TM here. So we're basically pushing taxation up in the tax havens. And that means if we then consider welfare in the non-havens, well, two things happen. So first of all, to the extent that firms continue shifting profits to havens, they'll pay more tax in the havens, and that will bring down the after-tax profits of these firms and will reduce the shareholders' consumption. That is a welfare loss from the perspective of non-havens. And then there's a positive effect, which is, of course, firms will also respond by reducing the amount of profit shifting, and that will increase revenue in non-havens, which is good from the perspective of non-havens. So that will tend to increase welfare. So there are these kind of two counterbalancing forces, and it's not a priori clear which one of them is strongest, so whether welfare net goes up or down. Just to put some numbers on this, so if you just imagine that we introduced a small global minimum tax rate of 1%, so that we have no such rate now we're going to use a rate at 1%, what's going to happen? Well, we start out based on some of the best evidence out there with profits shifting to havens amounting to around $600 billion annually. And let's just assume for now that we have like a corporate tax rate of around 20% in non-havens. So if I now introduce a global minimum tax of 1%, then the theory tells us that this will lead the havens to increase their tax rate up to 1%. And that will mechanically reduce firms' profits, after-tax profits, by $6 billion, 1% of what they're shifting to havens. That's a welfare loss. And then we can ask, well, how large would the reduction in profit shifting need to be in order for the reform to have like a net welfare increase? Well, it depends a little bit, because you could say, well, if these firms are owned by wealthy people that we don't care about their welfare, that have a small welfare weight in our social welfare calculus, well, then even tiny profit shifting responses will be enough to ensure that kind of the net welfare effect is positive. But on the other hand, if we are at a point where, you know, like on the margin, kind of this, our social marginal value of private consumption of the firm owners is similar to our social valuation of public revenue, well, then it should need like a reduction in profit shifting of around $30 billion in order to get like a revenue increase of around the $6 billion. That is what the firm owners have lost in after-tax profits. So that would require basically a high semi-elasticity of profits with respect to the taxation in havens of around that had to be larger than 5%. And this is not, I don't think, I mean, so I think some of the questions then, but how large is this semi-elasticity then really? I think some of Peter's latest work kind of gets at a parameter that is close to this parameter, but not exactly the same. So I think there's still this points to some empirical work that would need to be done to really kind of get at this semi-elasticity. All right, so let me say, I don't have a whole lot of time, so I'm going to say a little bit about the model, but it's going to be pretty superficial. But just, I mean, the overview, I have N countries in the model. Some are havens, some are non-havens. Firms have real operations. They only have like machines and factories and so on in non-havens. And all that is fixed, so they cannot touch their real investment or anything. So also their true profits are just given, and they are only in non-havens. But what they can do is that they can shift profits to havens, and this is basically the only margin of behavior that they have, that they can decide where to report their profits. Households just own firms and consume the profits, and governments tax profits and provide a public good. So how does the equilibrium look like without a global minimum tax? Well, this is going to be very standard. So basically, there'll just be one place in the world, or there'll be one tax rate that is the lowest in the world. I call that tax rate TL. And then any firm, no matter where it's based, it's going to report profits in the following way. It's going to say, if in a country, if the tax rate is above the lowest existing rate in the world, well, then I'm going to underreport my profits up to the point where kind of the marginal benefit of underreporting equals the marginal cost. And then they're going to be like one or more countries that actually sets a tax rate equal to this lowest rate in the world. And here there'll be overreporting. So everything that is underreported up here is going to be overreported in the countries that has this very low tax rate. So this leads to the following equilibrium in government policies. And let's consider the havens first. Basically, you're going to get this Nash equilibrium where all havens set the tax rate equal to 0. And this is just because you're going to get a like Bertrand-style tax competition where tax havens have no firms of their own. The only source of revenue they have is if they can tax shifted profits. And because shifted profits only go to the place where the tax rate is lowest, tax havens will kind of undercut each other to the point where they all set a 0 rate. And then if you look at optimal policies in non-havens, so non-havens will just take this for given that there are tax havens out there that set a 0 rate, and then they will set the optimal tax rate given this constraint, and it's going to look like this, that they will tax up. I mean, so this is the social value of public revenue divided by, on the margin, the social value of private consumption, and there'll be, so this will not be 1 here, big as it would be in a closed economy, because there are 2 policy externalities here. There's a profit shifting externality, the fact that, if I raise my tax rate, I'm going to push more profits out. That's going to reduce my taxation. And then there's like a tax exporting externality, just the fact that firms reporting profits in my country are partly foreigners, so I can tax them for free when I use the corporate tax. So these are just these two kind of counterbalancing externalities. All right. So what happens when we have a global minimum tax? Basically, for the firms, it changes the fact that now suddenly the relevant tax rate for them is the maximum of the tax rate it observes in a country and the global minimum rate. So basically, if I see a 2% rate in Bermuda, it doesn't really make Bermuda any more attractive than another country with a tax rate of 15%, because I'll always kind of be paying total taxes up to the global minimum rate if the rate is below that global minimum rate. Okay. So now what is the relevant cutoff for firms now is this TM, like global minimum rate. So, and they're gonna then underreport in all countries where the rate is above that global minimum, and it's gonna overreport in all countries that have a rate smaller than or equal to that global minimum rate. That means, as I argued before, that basically the equilibrium will feature now all havens setting like a tax rate equal to the global minimum rate. And the intuition is pretty clear that there's nothing to gain for havens by undercutting the global minimum rate, because then from the firm's perspective, the effective tax rate will be the same, because any difference between the global minimum and the rate in the countries is going to be offset by total taxes. Okay, so basically the key insight here is that the global minimum rate just induces a one-to-one increase in equilibrium tax rates in havens. All right. Now welfare, and I have only a few minutes left. The welfare, the key question is this: does the global minimum welfare, global minimum tax make non-havens better off? And let me just focus here on, to start with, on like a small reform. So we're going to consider like how a small shock to this TM, to the global minimum tax, how it affects welfare in non-havens. And we're going to just shut down this tax exporting channels for now, because it complicates matters a little bit, and only focus on the profit shifting policy externality. And now, like the welfare effect in non-havens of increasing the global minimum tax a little bit is given by this equation here. And basically there are two effects. So one is that I'm going to, when I increase the global minimum tax, I'm going to reduce private consumption, holding everything else constant. Why? Because I'm going to push up the equilibrium tax rate in havens, and that will reduce the after-tax profits of profit-shifting firms. Okay, and this effect is exactly proportional to the initial amount of profit shifting to havens. And then there's the positive effect, which is that there'll be less profit shifting, and that will increase government revenue and make everybody happier through this channel. All right. You can ask if there are other effects, but actually, like everything else falls out here because of the envelope theorem. So these are the only two effects that are left. And as I said, like to start with, so these have opposite signs, and it's not, you cannot a priori say which one's strongest. So like there are these two effects that basically, like, yeah, make it ambiguous, like what is the welfare effect of this global minimum rate. Things become a little bit easier if you consider a large reform, in particular if you consider a global minimum tax introduced at a rate that is so high that profit shifting ends. Say, for example, that you have in the extreme global minimum rate of 1,000%, whether no one is gonna shift profits, and you're gonna end up in this first best bliss point, where basically you have no leakage to havens and you have no distortion of your policy choice. So you're just like in the first best here. So the lesson is like that if you have a smaller, so you introduce, like when you start introducing a global minimum rate at a low rate, there's a risk that the higher tax rates in havens will kind of eat up the welfare gain. So basically you're going to have some of the welfare gain being captured by havens, and the net effect on non-havens might be negative. But if you make a reform that is large enough, so you have like a global minimum tax at a large enough rate, well, then you're sure that ultimately the effect will be positive. I'm already over time, so I just wanted to point to the number of limitations. Very simple framework. There are a lot of things that that you could improve and that are not considered in the model. I don't have time to really consider them now, so let me just stop here. Thanks very much for listening, and I'm looking forward to your comments. Thanks.
Thanks a lot, Niels. So on to the second paper. The presenter is Teresa Neve from the EU Tax Observatory. Please go ahead. You have 15 minutes.
Can you see my slides? Can you hear me? Great.
Yes.
I also want to thank you for organizing this very great workshop where we bring together so many different perspectives on tax avoidance and the global minimum tax. I would like to contribute a rather empirical perspective. This is joint work with Mona Barake, Paul-Emmanuel Chuk, and Gabriel Suckman. And we estimate the revenue potential of the global minimum tax under Pillar 2 on a country-by-country basis. As a motivation, before I go into our method and data and results, I would like to just make everyone catch up with the history of the global minimum tax. So basically, in 2013, cooperation between the OECD and the G20 started, where the main priority was to tackle tax avoidance of corporations. This resulted in 2015 in the adoption of the BEPS package, which included 15 actions, and Action 1 includes the global minimum tax, the two-pillar solution, and Pillar 2 is the global minimum tax. In October 2020, we have seen the first blueprints of Pillar 1 and Pillar 2 by the OECD. So this is basically the first discussion of the details of how a global minimum tax could look like, and the first revenue estimates of such a global minimum tax. And then we saw in 2021 how developments sped up, basically. We saw that larger nations, especially the front runner was the US, were aiming for a quite ambitious minimum tax of maybe 21%. We saw in July the first joint statement of more than 130 jurisdictions in the inclusive framework, laying out the main details of a global minimum tax under Pillar 2. This was refined in October, and in December, we now have the OECD model rules and the EU directive draft on the global minimum tax, which really in detail lays out all the parameters that are needed for an implementation of the global minimum tax, except for some details on implementation and compliance. So when we look at 2022 now, we're heading for the public consultations at the OECD level, and we are quite sure that the EU directive, or we think that the EU directive will be approved soon, and the implementation is already envisioned in 2023. So there has been quite a political process, especially in the last year, that has sped up in the last year. And what can we contribute? So for the last year, we've been following all those developments by providing country-by-country estimates on the revenue potential of Pillar 2 of the global minimum tax, always adapting to the newest rules we found in the July agreement and the October agreement. And now here I will present the newest results according to the model rules and the EU directive draft. Our main questions for the study are: what are the revenue gains, especially for EU member states, but also for other countries? How do the carve-outs, I will come to the carve-outs in a minute, influence the revenues? And what is the geographic distribution of those revenues? So which countries will actually have revenue gains? But also our study has some limitations, and I want to name those up front. So we only model a part of the Pillar 2 global minimum tax, which is the income inclusion rule, but the income inclusion rule is the most potent tool that to raise revenue. So I think we here cover most of the global or the Pillar 2 revenues. But we only capture first round effects, so that means we do not account for multinationals changing their behavior, where they book profits, how many profits they book, for example, in tax havens. And also we work on imperfect data, so we only have a limited number of years, only 2016 and 2017. We work with the OECD aggregate CBCR data, which makes data cleaning, for example, quite difficult, or more difficult than if you work with microdata. However, I think we can show you the right order of magnitude of what the world would gain from a global minimum tax of 15%. And we find that Pillar 2 can create substantial revenue, about 180 billion euros globally. However, the distribution, so which countries will gain most from the global minimum tax, depends on the rule that will apply to which country can collect the extra revenue. So for the July and the October agreements, we have seen that the headquarter country, so for example, if French multinationals have undertaxed subsidiaries in Hungary or in Poland, then France would collect the top-up tax revenue. And in this headquarter scenario, especially the EU and the US would be the main revenue gainers here. However, in the model rules, we have seen a new rule, the qualified domestic top-up tax, which gives priority to basically the subsidiary country to collect the top-up tax revenue. This would shift basically the revenue accrual more to the subsidiary countries and changes the global distribution of those revenues. I don't have time to go into the literature, but I just want to say we are not the first to use this CBCR data, and we're also not the first to compute revenue estimates with this. But I think our contribution is that we provide really timely estimates and, for example, now for the new model rules and the EU directive. And with this, I want to go into our data. Our main data set, as said before, is the OECD's aggregate CBCR data for 2016 and 17. This is anonymized data. It is based on micro-level country-by-country reports that are gathered first at the national tax authorities. And those national tax authorities aggregate this data at the parent partner level. So basically in each cell, we see that French multinationals, how much French multinationals book in Hungary, or yes. We have quite a variety of information. We have profits before tax, taxes paid and accrued, tangible assets, the number of employees, and also the revenues of those French multinationals if they book in Hungary or in Poland. And we try to use all of this information for our analysis. The data sets only includes the companies in scope, which are with a global turnover of more than 750 million euros. The main limitation of this data set is that for some countries, we only have a continental spread. So for example, for Austria, we only see how much Austrian multinationals book in Europe or in Africa. This complicates analysis. Also, we have the issue of possible double counting of dividends, which would increase the profits before tax, but not the taxes paid. Fortunately, some of the countries like Sweden and Great Britain already provide adjusted profits, and we use all the information we have on this double counting issue. And last, as I said before, we have limited data cleaning possibilities due to the aggregate data. Our main sample is the 2017 data and the positive profit sample, so that we don't underestimate the effective tax rate. And in this data set, we have 38 unique parent jurisdictions. To enhance the scope of our study, we additionally use the data by Turslov, Weir, and Suckman. This is the Missing Profits of Nations project. They provide a data set that is based on national accounts and foreign affiliate statistics, and they provide corporate profits that are booked in tax havens by the country of the ultimate owner, and they provide profits and effective tax rates of domestic firms. The main drawback of this data is that they include companies above and below this in-scope threshold that Pillar 2 has. And we use additional data, but I don't want to go into detail here, like the ECB exchange rate and the World Economic Outlook, so we can show all of our results in 2021 constant euros. I would rather like to lead you through our step-by-step method very quickly. So we start by using the OECD CBCR data. We compute the effective tax rates as 2-year averages of the 2016-2017 data. That makes our effective tax rates quite stable. And then we complement this data set with the Turslov, Weir, and Suckman data, as said before. And then we compute the carve-out. The carve-out is a provision that accounts for, or it supposedly accounts for, real economic activity. And it decreases the tax base. So basically the profits to which the global minimum tax rate of 15% applies. And the carve-out, as laid out in the agreements, is 5% of the value of tangible assets and 5% of payroll. And as you see here, it decreases the tax base, as said. And with this, we have all the ingredients to compute the revenue. We start with the headquarter approach. So we take the example again of French multinationals that have subsidiaries in Hungary, in Poland, or in Italy. Let's take the example of Hungary, because French multinational with a subsidiary in Hungary, because Hungary has a nominal corporate income tax of 9%. Then the revenue the French state could collect from there is the difference of the 15% minimum tax and the effective tax rates the subsidiaries of French multinationals face in Hungary, multiplied with the profits the French multinational subsidiaries book in Hungary, decreased by the carve-outs they have due to the tangible assets they have in Hungary and payroll they have in Hungary. And so this is only for the example of Hungary, but the French state under this approach could collect the tax deficit not only from Hungary, but also if French multinationals have subsidiaries in, let's say, Italy that are undertaxed, then it also can collect this revenue from those countries. Now there's a new provision in the new model rules and the EU directive, which is the qualified domestic top-up tax. And this changes the priority who can collect the revenue from the top-up tax. We take the same example of French multinationals booking profits in Hungary. And in this case, Hungary collects this the revenues from this example. The parameters stay the same, the 15% minimum tax, and the difference to the effective tax rate the French multinationals face in Hungary, multiplied by the profits the French multinationals book in Hungary, decreased by the carve-outs. But this amount now goes to Hungary, or Hungary has the priority to collect this tax deficit if they apply this qualified domestic top-up tax. So as you can see, we now have two different rules. Until October, we thought the headquarter approach applies. Now we have this new rule. The bottom line is that the aggregate revenue globally that can be collected globally stays the same, but the geographic distribution changes substantially. And with this, I would like to go right into the results. So here you can see the results for the headquarter approach. This is the revenue potential in billion constant 2021 euros. And this is, again, the example where the French state collects the revenue potential from the global minimum tax if French multinationals have undertaxed profits, for example, in Hungary or in Italy or in Germany. We can see under this approach, or I plot here or I show here, the revenue potential without carve-outs, with the carve-outs that will apply in the first year, where you have increased carve-outs. This would be supposedly 2023, and with carve-outs in the long run. You can see that the EU under this approach would gain quite substantial revenue between 64 billion and 80 billion euros. To put this in context, around 80 billion euro, this would be around a quarter of current corporate income tax revenue. So this would be a substantial revenue gain for the EU. The main winners would be, for example, Germany, which has a lot of headquarters, but also collects revenues domestically. I would take the example of Belgium with caution. We discussed this example in our latest note, which came out in October, why those numbers might be so high. But we can also, for example, see that France gained substantial revenue of around 3.5 billion euros. This is the second half of the European countries. Here we have the same pattern that, for example, the bigger countries like Spain can gain substantial revenue, but also some of the European tax havens like Luxembourg and the Netherlands.
There is, I have about 2 minutes left.
Okay, I have to speed up. A last detail on the headquarter approach. Under the headquarter approach, if we look beyond the EU, then the United States might be the main winner of this global minimum tax with an extra revenue of around 50 billion euros. Okay, and this was the headquarter approach. Now with the new model rules, we have the qualified domestic top-up tax. So in the example of French multinationals in Hungary, Hungary would collect the revenue. And this would mean in our computation that the EU would still gain substantial revenue between 46 billion and 64 billion euros, but this is less compared to what we had. We had 70 billion in the long run, now it's 50 billion. What we see is that some European countries do substantially. For example, France hardly has any tax deficit left, under this approach. And when we look beyond the EU, for example, we see that the United States, which was the main winner before of the global minimum tax, now decreases its potential revenue from around 50 billion to around 3 billion euros. And with this, I would like to wrap up. So in our study, we combine the OECD aggregate CBCR data with the TERSLOF data to compute the revenue potential of the Pillar 2 global minimum tax according to the newest OECD model rules and the EU directive. And we find that this global minimum tax, even though the rate is quite low, can raise substantial revenue between 170 and 180 billion euros globally. The carve-outs reduce this revenue potential substantially, and the geographical distribution depends on how countries adopt the rules. So if the countries adopt specifically the qualified domestic top-up tax, which is in the new model rules and the new EU directive. If the countries don't adopt this new qualified domestic top-up tax, but stay with the headquarter collection, which we saw in the previous agreements, then the EU and the United States would gain most of the revenue. If all countries in the world adopt this domestic top-up tax and the source countries, so the subsidiary countries, collect the revenue, then the EU would still gain substantial revenue, but the US, for example, would gain less than 5 billion euros in revenue. However, I have to caution all of, especially our results on the domestic top-up tax, because this is prior to behavioral effects. And we think that while our headquarter approach results are quite stable, our estimates for the qualified domestic top-up tax, so if subsidiary countries collect, might be quite sensitive to that multinationals book less profits in tax havens. And with this, I thank you.
Thank you very much, Teresa, for that empirical side of things after we heard from Niels, the more theoretical side. Okay, let me go to the last presentation of the session. Peter, are you with us?
All right.
Perfect.
So good afternoon again. So in this paper, with my excellent colleagues, Javier Garcia Bernardo and Gabriel Zuckman, we look at whether the profit shifting by US multinationals was reduced by the 2017 Tax Cuts and Jobs Act. We start with two observations. So one thing is there's an increasing amount of research on profit shifting by US multinationals. The other observation is that in 2017, the Tax Cuts and Jobs Act was the largest reform in the United States over the past 3 decades. And so the straightforward question we try to answer in this paper, did this act reduce profit shifting by US multinationals? And we argue that the answer to this question might be relevant also for the global minimum discussions that we've heard about in the past 2 presentations. We answer this question by exploiting a number of relevant data sources on US multinationals. Perhaps the most important one is the survey of US multinationals from Bureau of Economic Analysis, but we also heavily rely on financial accounting, firm-level information from CompuStat, as well as new data source from the IRS country-by-country reporting data. And in this, we see our methodological contribution because we correct the double counting in the country-by-country reporting data. And after the correction, we show that existing data sets paint a consistent picture. What the picture looks like, what are our main findings? So we show that US multinationals book slightly lower share of their profit abroad after the reform. So it used to be 35% of profits were reported abroad, whereas in 2020, latest year for which we have data, it was only 30%. So there's a 5 percentage point drop in the foreign profits as a share of total profits. But we showed that this drop is driven by a few technology companies who have repatriated intellectual property to the United States. And despite this, we showed that the amount of profits booked in tax havens is still large. It's either 50% of all foreign profits or 15% of all global profits, including the US ones. And we using this following graph, we argue that this is a historically high level for profits booked in tax havens. So this is based on the combination of two data sets on national accounts and the Bureau of Economic Analysis data. And we have a share booked in tax havens as a share of all global profits of US multinationals. And we see that in 1990s, this share booked in tax havens was around 5%, let's say. Then in 2000s, 2010s, it was around 10%. And then last 5 years, since mid-2010s, the share booked in tax havens rose to about 15%. And it was there mostly unchanged despite the passing of the Tax Cuts and Jobs Act. So let me now discuss what is in this reform that might influence profit shifting. We argue that the Act dramatically changed profit shifting incentives, and most of the provisions included in the Act reduced incentives of US multinationals to book income in tax havens. So perhaps most importantly, there was a decline in the statutory rate from 35% to 21%. And there were three other provisions that all were aimed at reducing profit shifting. So there's a reduced rate on intangibles booked in the United States. There's also limited deductibility of certain payments, which were suspected of being used to shift profits to tax havens. And there's also the so-called GILTI, perhaps the provision similar to the global minimum tax discussed at the global level now, that was already implemented in the United States from 2018 on, so-called global intangible low tax income. Although let me say that in contrast with the global minimum tax discussed at the global level and agreed at the global level, the GILTI has been applied for all countries, for all foreign countries together, whereas the global minimum tax, as agreed at the OECD level by the inclusive framework countries, it is applied at the country-by-country basis. On the other hand, there's at least one change that might increase profit shifting to tax havens, and that's a move from a worldwide to a territorial tax system. So overall, it remains an empirical question where, how much the Act influenced profit shifting and whether it led to reduction or even increase in profit shifting. And because this is an empirical question, we use a number of data sources, and we start with the distinction between profits booked in the United States and profits booked abroad. And before we move on to firm level analysis, let me show you a few simple descriptive trends using three different data sets for the past 40 years, where we're looking at the share of foreign profits in global profits of US multinationals. We have three different series that are similar but not exactly the same. We have the share of foreign profits in contrast with all corporations from the national accounts. Then we have multinational corporations from the Bureau of Economic Analysis survey, and we have only listed corporations from Compustat. But across these three different data sources, we observe around 5 percentage point drop in the share of foreign profits in global profits. So this seems to be a consistent picture from all these three data sources. But to understand it better, we need more detailed data, and we use Compustat to shed more light on where this drop is coming from. We are studying the Compustat data to see large companies that have observed a large drop in foreign income share over the past few years. And there are 5 such companies, including Google. So that is slightly going to the theoretical example of Niels Johannessen, who have used Bermuda and Google, perhaps United States. And here we see that Google has moved its intellectual property from Bermuda to the United States. And so from 2020, it licenses intellectual property from the United States. And there are similar stories for the other 4 companies. For Google, we can, I argue, we can see this change in licensing intellectual property, not from Bermuda, but from the United States, in the foreign profits of Google that are going down substantially between 2019 and 2020, whereas the domestic profits are going significantly up again between 2019 and 2020. So this is one of the stories behind the macro drop of 5 percentage points. And when we sum up the changes in 5 companies that have all underwent a large drop in foreign profit share, this sums up to 3 out of 5 percentage points. So we were able to identify 5 companies, Microsoft, Alphabet, Facebook, Cisco, and Qualcomm, that together explain most of the macro decline in foreign income share. So our conclusion on this is that perhaps there is some repatriation of intellectual property, mostly of technological companies going on, but it does not seem to be the norm. This seems to be more exceptions. The data sets used so far enable us to distinguish between profits abroad and domestic profits. But when we want to identify specific companies where the profits are booked, including specific tax havens, we need other data sets, and we use 3 of them in this section of the paper. The preferred data series is a so-called profit type return that is included in the Bureau of Economic Analysis survey of foreign operations of US multinationals. And it's a gross of foreign income taxes. It does not suffer from any double counting in profit. And fortunately, it does not cover Puerto Rico. But otherwise, it's the most, it's the preferred data series. And it's used in this graph to show the role of individual tax havens over time as a share of all foreign profits. And over the past 5 years, pre and post reform, we can see that around 50% of all foreign profits using the profit type return series, 50% of the profits are reported in these few selected tax havens. The other 2 data series that we can use to understand the exact location of foreign profits are the following. So we have from the balance of payments, also accessible through the Bureau of Economic Analysis. There's the direct investment equity income data series that differs in some respects from the profit type return. For example, the profits of affiliates of more than 10% owned are included, whereas for the profit type return, it's majority owned. Here, the profits are prorated by the ownership stake of US parent, but it's not the case for the profit type return. Here, the data is net of foreign taxes, whereas for profit type return, it's gross of foreign taxes. And here, it's assigned to country with immediate link with the United States, whereas it's on accounting basis in the case of profit type return. But direct investment equity income series also does not suffer double counting. Third, let me discuss the data source that is exciting because it provides the best coverage in terms of number of countries covered, including Puerto Rico and many developing and other countries. It's the country-by-country reporting data. The major problem with this data is that some companies are double counting profit due to unclear guidance on how to account for intra-group dividends. In this paper, we recognize this problem and we provide a very careful correction to match true foreign and domestic profits totals. And it's reassuring to say that the totals after this correction match very well. And so we believe that the adjusted country-by-country reporting data after this correction can be used reliably. I've introduced 3 different data sets, one coming from the balance of payments, another from survey of Bureau of Economic Analysis data, and the adjusted country-by-country reporting data. And I have them here all for the available years between 2015 and 2020. And on the horizontal axis, 100% is all the foreign profits, and the various colors reflect specific countries, mostly non-havens in blue color, and 2 groups of tax havens in red and yellow colored profit centers, mostly used for booking profits and coordination centers, including also some management activities. The main observations from this graph is that the share of tax havens is very similar and stable across the data sets and across the years, and it's around 50% of the total foreign profits. So the finding from the preferred data series profit type return is confirmed by the balance of payments and the adjusted country-by-country reporting data. Last but not least, we are, in addition to looking at profits, we're also looking at the effective tax rate. And the main finding there is that the effective tax rate on domestic profits decreased substantially following the reform. There was a 14 percentage point drop in statutory rate, and in the effective tax rate, we observe a slightly lower percentage point decrease of 10%, but it's consistent across all the data sources, including profit type return, Compustat, and 2 versions of the country-by-country reporting data for all companies, as well as for only those that are profit-making, excluding loss-making companies. So there's a decrease, a large fall in the effective tax rate. So let me wrap up. In conclusion, let me highlight a few of the main results. So we observe that there has been a repatriation of profits to the United States by a few companies, but the share of foreign profits booked in tax havens is about 50%, and share in all profits is about 15%, and seems persistently high. Also, interestingly, final note is on the effective tax rates, to which we observe the drop is to 15%. So United States now tax its multinationals at about the rate that corresponds to the global minimum effective tax rate. And I leave it up to you what consequences this might have to the raise to the new bottom or for the tax competition more broadly. Thank you.
Thank you to all our 3 presenters. Let's go to the discussion now. I know that Niels will have to leave soon due to other engagements. So if we have any questions or any urgent matters for him, let's prioritize those. Otherwise, I will give the word to Nadine, who has opening remarks for the discussion.
Sorry, so can you see my slides? Yeah.
Yes.
Okay. So thanks for giving me the opportunity to discuss these 3 papers. So this is a session about global minimum taxation, and I think the general questions, and they are all these 3 papers contribute to answering these questions, is: does the global minimum tax impact on profit shifting? How does it impact on revenue collection? How does it impact on countries' policy choices and on welfare? So if we start about thinking about profit shifting, then of course it's very obvious. So this is also a point that Niels made, that closing the tax rate differential reduces shifting incentives, and that is also consistent with like a large body of empirical evidence. One point that I want to make, however, is that, and this was also brought up by Teresa, so if you think about the global minimum tax, then this is not introduced on a blank space. So we already introduced like a large set of anti-shifting provisions in recent years, so unilaterally, through BEPS, through ATAD. And some of these provisions are conceptually quite close to what is now proposed or agreed upon under the global minimum tax. So if you think about the income inclusion rule, then this is very similar to CFC. If you think about under tax payment rules, then there's a link to interest and royalty deduction limits that we have in several countries. And so I think the main question is whether now these additional rules have any additional effect, given what we already have in place, what is conceptually not so super different. So that is the first point. I think the second point, and that was, I really like the paper that Peter just presented, so about the US reform, because the US, so some parts of the US tax reform served as a blueprint essentially for the global minimum tax. And so it's, I think, really striking evidence what Peter and co-authors present, that the share in foreign tax havens of US multinationals profits did not change substantially. And of course, that triggers the question to ask, is the minimum tax rate effective or not? Yeah. And of course, there are confounders. So there were other provisions that were simultaneously implemented in the US tax reform. And Peter already said the GILTI has a worldwide blending. The income inclusion rule is arguably tighter with the country by country blending. But still, it puts a question mark, at least, behind that. And I think Teresa's paper is also very interesting because it's so important to say, what happens to tax revenue in high tax countries. And this is very careful work, is suggesting that the countries gains are likely to some extent, depending on design, concentrated in more developed economies, high tax countries. But still, Teresa was very careful talking about limitations. So let me add two limitations. So one goes back to the provisions that we already have in place. So if you, for example, think about CFC provisions, then countries currently already collect revenue from that. And to my understanding, this is not accounted for. But of course, this somehow, the question is how big are these revenues, and they should be subtracted. I think there's a data problem here, of course, but I think this is a valid question. And the other point was brought up by Niels and in his paper to say, what is the policy response of the countries? So if the tax havens really increase the tax rate, then this shifts the whole distribution of revenue gains to the tax havens and away from the high tax countries. And I think this is also a very valid point. And then Niels' paper then basically moves on and says, okay, what is the impact on policy choices, the impact on welfare? And as he presented very clearly, the analysis has like two components to say, okay, what happens if I have like a small minimum tax, or increase the minimum tax from 0 to 1%? And then another analysis where he basically says, okay, what happens if I have a super large increase in the minimum tax, essentially to the level of the high tax country, so that profit shifting is fully curbed, and then you have a welfare increase. And of course, in a sense, you ask the question, what is the intermediate case? So what happens if the envelope theorem effects do not cancel out because you look at a small change? So if you think about the effect on tax competition, then let me add just a few thoughts on mainly like related to Niels' analysis, I guess. So the first question is, do the low tax countries really raise their corporate tax rate to the minimum rate? And they might, but it's not fully clear. And I think it's not fully clear for two reasons. The first is that the Pillar 2 rules only apply to large multinationals. So there are multinationals for which these rules are not applied. And then probably more importantly, there are these carve-outs. And so the low tax countries may still have incentives to keep their tax rates low to attract real activity and smaller firms. And then the question is, what happens in the high tax countries? So this was what Niels already discussed in his paper. So and his findings are also ambiguous, so that it's not clear whether you have a standard effect that the tax rate increases, or there may be countervailing effects that the tax rate drops. So one countervailing effect is listed here with a paper by Kai Conrad, who says, okay, if you introduce a minimum tax, then the corporate tax rate set by the high tax country may also decline, because the high tax country does not need to fear that the low tax country retaliates by also decreasing its tax rate. And then you may potentially have fiercer competition for real investment because of these carve-outs, and because of the fact that we potentially closed all these profit shifting channels. And then of course the tax rate has a stronger impact on the real economic activity allocation. And then there are these standard arguments that if you do not have the competition and the tax instrument, it may of course potentially shift to other instruments. Okay, so before I close, let me make two other points. The first is complexity and the other is participation. So I think one point that gets too little attention in the policy discussion is that now we already have like a quite complex system of anti-shifting provisions. And what Pillar 2 now does is build like different but somehow similar rules on top of that. And the plan, as I understand the EU, is that these rules should coexist for a number of good reasons. But what happens is that the system gets more complex, and arguably the administrative burden on governments and taxpayers may increase quite substantially. And especially if you talk to less developed countries, then they stress that point and say, these rules are so complex, it's really hard for us to administer these provisions. And I think this is something to take into account. And the last point is participation. So all papers, in a sense, implicitly assume that all countries will adopt this minimum tax. But this is not what the countries agreed in the inclusive framework. They only agreed on a common approach. So they only said, okay, if you want to, you can implement this minimum tax and I will accept that. And if I implement it myself, I implement it according to the OECD rules. But so it's not like fully clear who will participate. And Niels' paper essentially made a point why countries may not want to participate. But participation, of course, and how many participate shapes revenue and welfare effects. And what happens currently in the EU is that we have this EU directive proposal to incorporate the Pillar 2 in the EU, and here it's mandatory. So this is actually quite striking. So the OECD said it's optional, and the EU says now it's mandatory. And it may be good for implementation on a global basis if like a big player like the EU says, okay, we go ahead and implement that. These rules may make it more likely that others adopt them as well. But the downside, of course, is that if the others do not follow suit, it might not be so easy for us to adjust, because we have this anonymity in tax matters in the EU. And I think this is like the trade-off. Okay, but otherwise, I really enjoyed reading the papers. Great work. Thanks for allowing me to discuss that. Thanks.
Thank you very much, Nadine. Niels, I don't know if you want to comment before you have to go. Or...
No, I agree with everything Nadine says. Like, it's a great discussion. Thanks very much. And in particular, kind of the two limitations applying to like my paper, that that this tax rate dynamics in havens probably does change if you allow for like the carve out and also for like this size threshold. So there'd be there's like a partial scope, you could say, of the global minimum tax that will change the dynamics, and also the results probably some. So these are points well taken. Thanks very much. I really enjoyed being part of this and also seeing the other papers. So thanks very much. I need to log out now.
Thank you, Niels. Have a good day. Okay, so for the discussion, I do not see any comments in the chat now, and I also don't see any on YouTube. Is there anyone who would like to speak up, unmute themselves, and raise their hand? Any of these? Okay, then I will use the opportunity and ask mine. I was not sure if we will get to that, but I do have a question for Teresa. So there was a in one part of the simulations that you've done, when we compare it to the other simulations, the top-up, specifically the top-up provision, I saw that some countries are losing or would be gaining much less than from the other proposals or other particularities of the reform. Is there any lessons that countries who would gain a lot from this are not doing that the other countries who would not be gaining so much from this are doing? So is there any way for the countries that would be gaining, in other words, they are now losing, to implement themselves? Is there anything that connects them?
Thank you for this question. I hope I understood it correctly. So we're talking about the headquarter approach, which was in the agreements in July and October, and there the main mechanism was that the headquarter country, like I had this example of the French multinationals and the subsidiaries all over the world, and the French state would collect the revenue. And now in the new model rules, the qualified domestic top-up tax, so the subsidiary countries can collect. I don't know if it's about what countries can do to change, like for example, the US that gained under the headquarter approach around 50 billion in our estimates and less than 5 billion in the new approach. I'm not sure what they can do, but I also don't see that as a negative development, in the sense that in one of our reports, in our last report in October, we showed how much high income countries versus low income countries would gain. And if you take the headquarter approach, this gives basically the right to collect to the high income countries where a lot of multinationals are. And this made quite an imbalance basically in the distribution of this revenue potential. And a lot of developing countries and a lot of NGOs also flagged this already. And so now we have this rule where the developing countries could actually take the priority and get this revenue. And so I think that's actually a good opportunity. I think only that the problem rather is, as Nadine also hinted at, it's not clear if all of the low-income countries will implement this, if they have the administrative capacity to implement a qualified minimum tax like this, or a minimum tax in a country that also has priority. So I think this is the discussion. I hope I answered your question with that.
Yeah. Thank you very much. I think it's really important to have good empirical estimates of the potential impacts. And I was wondering, just with a quick follow-up, and I do see one question now, so I'll get to it right away. But you might be in the best position of any of us to work with confidential data from CBCR reports. Have you tried to make these simulations even more detailed?
We would love to. So at the EU Tax Observatory, we try to build cooperations with tax administrations, but this data is very, very sensitive, and you have to build like procedures to keep the anonymity. So this is work, and I hope more tax administrations will cooperate with research institutes on this, but this will take years to really establish good routines to work confidentially with this data. And I hope this will come in the next years, but until now, we cannot access microdata.
So I see a question from Martha in the chat, but I also see that your camera is on. Would you like to ask it out loud? No, okay. So let me then read it. I assume this is for Peter. It's about the Tax Cuts and Jobs Act and its incentive to book more profits in tax havens. This incentive was described as a move from a worldwide to a territorial system. Could you talk more about that, Peter?
Of course. So in the system pre-TCJ, pre-reform, the foreign profits were subject to US taxation upon repatriation. This has changed, and now in the territorial system in the United States, the foreign profits are exempt from the US taxes. And so This, in theory, increases incentives of US multinationals to shift profits abroad because they will not be subject to any taxes in the United States. But of course, so BEAT is one of the provisions, I think, directed against this, let's say, profit shifting out of the United States. Measures to limit the deductibility of certain payments suspected to shift income out of the United States. So there's the base erosion and anti-abuse tax BEAT. But as I'm not an expert on worldwide and territorial systems, and it's not black and white, and so it used to be a combination of the two before reform, and now it's a combination of the two systems in the United States, but it moved more towards the territorial system. So does that answer your question? Thanks.
Great, I see a thumbs up. Okay, do we have any other comments or questions from the audience? Yes, I see a hand up. Sarah?
Yes, I have a question to Nadine, because I find the point of the overlapping anti-avoidance measures quite interesting. And I was wondering if you, like, for example, the CFC rules, would you agree that maybe for the EU, there won't be a big overlap because they can hardly be applied to other or EU tax havens, which are very important for profit shifting in the EU? So this might be more a problem than, or not a problem, but a phenomenon important for US revenues or for revenues of non-EU countries, or do you think this is also, like, there might be also important effects on revenue estimations for the EU?
Yeah, I guess that's a good point. So the main difference is, of course, to which type of income does it apply? Yeah, and this is under the CFC provisions smaller, and in the EU because we had these EU juridical decisions. This is particularly little income to which it potentially applies. Yeah, and then so that is one difference. So the minimum tax, also applies to active income. Yeah, so CFC in general only to passive income. And then the other difference is that with the minimum tax, you basically top up to the minimum rate, and with CFC you top up higher, arguably in many countries, to the national corporate tax rate. So this is the difference. And when the Pillar 2 was first brought on the table, I guess many people thought that these systems would somehow be integrated. So I guess one question is, can we have any additional gain on top of the CFC provisions? And the other aspect is this administrative complexity that we say, okay, we had BEPS first, and then we did, why didn't we do Pillar 2 right away? So Teresa, when you described it and referred it to Action 1, so Action 1 and the BEPS is actually, it targets the digital economy, but now as it is designed in Pillar 1 and Pillar 2, it's much broader. So it goes beyond the digital economy. So what actually happens is that BEPS said, okay, we tackle profit shifting and we do it through CFC provisions, through interest limitation and deduction limitation rules. And then essentially they thought, okay, we could do Pillar 2. And this is like similar, but arguably broader. And I guess my concern is a bit that we have like many provisions in place, and now they are arguably they are kept all, and that increases the complexity. And I guess eventually, as Teresa also said, it's an empirical question. So what is the additional effect is essentially an empirical question. So arguably, I would expect there is an additional effect, yeah, beyond what we already have in place. But we also have the deduction limits already in place, yeah. And I guess we had hoped for a more consistent system where you don't have all these provisions next to each other. But I guess the main reason is that now we have the Pillar 2 only applying for very large firms. And I guess that is the main reason why they want to keep the other systems in place that you also rules targeting smaller entities. And in some regards, the CFC provisions are also tighter, as I said, because they channel the tax burden up to the national corporate tax rate, not only to the minimum tax rate. But I guess eventually it's an empirical question. I'm looking forward to all the empirical evidence that you hopefully will see on that. But yeah, I think it's a difficult it's a difficult move forward. So I think there are pros and cons.
Okay, I see a question in the chat from Nessa. The lessons seem to be there were weaknesses in guilty and also pillar 2, rate too low, carve-outs, unclear who will implement. Can the presenters comment more, as these are important in terms of formulating strengthened proposals and also knowing where to look to identify further tax gaming? So any of the presenters would like to answer that question?
So I may provide a brief partial response, and I share the views of Nadine Riedel, and it's great to have you here, and and so it's pessimistic, let's say, and even the empirical answers might be not forthcoming or might be confounded by other things when we have a chance to evaluate any global minimum taxes we might see, as with the TCJA. But to be more optimistic, I think one lesson that was learned from the guilty implementation in the United States is that the global minimum tax should apply on country-by-country basis. This I think, jurisdictional banding. So hooray! This is in response to the questions we got. This is already been taken on board, and this makes a huge difference. I remember. At one stage, Teresa will know better at what stage, it was an open question. So we should celebrate the good choices that were made, although we may regret some of the bad choices. So this is just a small contribution from me, more optimistic.
Maybe I can add to this. If we talk about strengthened proposals, also when we already think about the future and the implementation of Pillar 2, we've seen that the proposals concerning the tax rate were more ambitious in the beginning of 2021. This has come down now to 15%, and we have the carve-outs, which also, as Nadine underlined, might actually strengthen or increase tax competition for real economic activity. And I think that's also what we see. So what I think is that this deal can curb paper profit shifting to Cayman and Bermuda, because then the 15% minimum tax and the carve-outs still give a lower floor that is higher than what multinationals would have to pay in tax havens. And usually in those small islands, you don't have a lot of real economic activity. But for strengthened proposals, the carve-outs or undermine a strengthened proposal. So carve-outs really might exacerbate real or tax competition for real economic activity, which might actually be especially severe in the European Union, where you have quite a mobility in capital and employees, because we have the common market. So I think those are my thoughts on if we think already beyond this implementation and to future proposals.
Thank you. Yeah, and I think on the question of complexity and the intended consequences of what ultimately gets through, I think it's important because the 15% is already somehow a compromise in the rate. Then without the additional existing rules still in place, we might end up with a very unpleasant situation where it's 15 everywhere. And so yeah. Anyway, thank you very much. It's 15:21. We are right on schedule for a 10-minute break before we have our session 2. So please let's join back in at 15:30. We'll keep this call on. We can just mute ourselves, and then Sarah will continue with the moderating of the session 2. Thank you very much.
Hello, everyone, and welcome to our second session of this research workshop on tax avoidance and policy responses. In the last session, we have discussed policy measures, mainly the global minimum tax, but also policy measures in the US and potential effects on tax revenues, but also on reactions of governments and corporations. And now we will have 3 presentations on corporate tax avoidance, which, as we will have seen, is not likely to disappear because of the minimum tax, even if incentives to shift profits might be reduced by it. So we will now have 3 presentations that deal with potential effects of profit shifting on inequality, on tax revenues, and also 1 presentation on how to measure profit shifting or corporate tax avoidance. And I would like to give the floor to Valeria Cecchini, who will present a paper on the effects of corporate tax avoidance on inequality. And Valeria Cecchini from the Charles University. Sorry.
Hello, everybody. Thank you, Sarah. I'm going to share my screen. So, I hope you see them. Do you see my screen?
No, not yet.
Okay. Let's see.
Yeah, now it starts.
Okay. Okay, thank you. So, thank you, Sarah. As said, I will be presenting the research project, The Indirect Costs of Corporate Tax Avoidance Exacerbate Cross-Country Inequality, conducted by Javier Garcia Bernardo, Daniel Haberle, Petrniansky, Miroslav Palansky, and me, Valeria Cecchini. We have estimates of multinational tax avoidance. We know that companies shift around $1 trillion US dollars to tax havens every year, and this costs government around 250 billion US dollars every year. However, we don't have estimations of the effect of indirect costs on profit shifting, and that's what we have tried to estimate with our research project. So we took into account in particular 2 indirect costs: the dividends, the taxation of dividends and capital gains redistributed to the shareholders having their residence in which those dividends and capital gains are then taxed, and the interest rate on country's debt, debt issued to recover the loss of profit shifting. So our question is, how does the picture change if we take into account the indirect cost? And is this are those indirect costs a disadvantage for the developing countries? So, all right. So we see here that we have. Okay, I tried to do that. I'm sorry. Okay, so we can see here that we have 3 charts. Sorry. Okay, we have 3 charts of in which we have in every chart the primary cost. So the primary cost is just the profit shifting. The full cost is made of profit shifting plus the indirect cost. And we have in red the countries in which the primary cost is lower than the full cost. So the indirect cost increases the final cost. And instead, in blue, we have the countries in which in which the full cost is higher, is lower than primary cost. And we can see that those countries are divided by their GDP per capita, and the countries that have a GDP per capita lower than $5,000 have, in general, a higher full cost than the primary cost. So, and these are the developing countries. While for the GDP per capita higher for $20,000, we can see that countries manage to recover the loss or even gaining from all the process. How did we manage to include those indirect costs in the profit shifting? So we constructed a dynamical model in which we have that in which at first we considered the direct effect, so the direct tax loss caused by the profit shifting. So we have the countries in orange shifting their profits to tax havens in blue, and we estimated this profit shifting through the misalignment methodology by Garcia Bernardo and Jansky. And we multiplied this shifting by the tax on corporate profits of the country I. So this will be the loss of the country I. And then we have we included the first indirect cost, which is the taxation of capital gains and dividends. So in this case, we have a flow in the opposite direction. We have tax havens redistributing some of the profits to the countries, in particular to the countries in which the investors have their residence. And we managed to reconstruct this flow thanks to the Pitware matrix estimated by Haberle's work. And in particular, here we have that the Pitware matrix connects the tax havens, so the profits and tax havens, to the investors that have their residence in the countries in orange. So what we do then is multiply these data metrics for the profits that are into tax havens. So we have here capital pi are the profits into tax havens, and then we consider that not all of those profits are distributed. So only a percentage of them are distributed, and this percentage, this rate is F. And then once they arrive in the country I from the tax havens, they are taxed to the tax rate, capital gains and dividend tax rate, tau. And we also consider that only a part of those of this flow is detected, which means that we have also a tax avoidance, which is alpha. So here then, now we have the tax loss for the country I. We have the tax gain to the capital gains and dividends taxation. And so we know the deficit, and we assume that the country will borrow to recover this deficit, will borrow the amount lost. So this is the amount borrowed times 0, BI 0, but this comes the second indirect cost, which is the interest. So at time t plus 1, the country I will not only have to face BIT, the new tax loss and the new tax gain, but also will have to pay the interest on what has been borrowed in the previous time. So in this way, we included the two indirect costs in our model, and we here have the effects on selected countries. So we can see in these charts that we have Uganda, Brazil, Mexico, Germany, United States, China, and Norway. And we wanted to understand how, which is the contribution of the indirect cost to the final cost. So in the plot A, we have the full model. And we can see that Uganda is the one that is losing the most But if we put an interest of the 5% to every country, then we can see that Uganda is losing far more less, Germany is losing more. And that's because Uganda is losing that much in the full model because it has a very high interest rate, while Germany has a very low interest rate. So we are increasing its interest, putting it at 5%. If we put an equal ownership instead, we can see that the situation changes a lot for Norway. Norway in the full model is gaining from all the process. With equal ownership, it's always gaining, but not that much. And that's because Norway manages to gain from all the process thanks to all the shares that owns. So we wanted to, however, have a wider image of the contributions of indirect cost to the final cost and to profit shifting. And that's why we decided to plot it into those heat maps. So here we have the heat maps that take into account the interest rate, the investors, and profit shifting. In particular, we have the interest rate on the horizontal axis, and we have the ratio between investors and profit shifting on the vertical axis. So the color instead represents the total cost, the final cost. And in red, we have a positive cost, and a darker red means a higher cost, while in blue we have a negative cost, which means again for the country that have that combination of interest rate and investors and profit shifting. And we can see how if we go on the right, so we have an interest rate that is higher, we also have a higher loss final cost. And instead, if we go on the left and even in the upper part of our plots of our heat maps, we have a higher share of investors, and a low interest rate, which means that the country recovered the loss of profit shifting or even gains from all the process thanks to the indirect costs. These heat maps have been obtained through an analytical approach. This means that from the model itself, dynamical model, we calculate, mathematically calculate the cost, and from the formalization of this cost, we put every combination of the indirect and direct costs, and we obtain the final one. With a different approach, we obtain, however, a similar result, an analogous result, matching result, which is this one. So we can see that here we have the same heat map that represents the same quantities, but the methodology is different. In particular, here we have synthetic data. So we have synthetic countries that have been created and simulated following the quantities of the real countries. So their population, their GDP, their profit shifting follow the trends of the real countries. And in this case, we also can see how the indirect costs are really important for the calculation of the final loss for countries. And also considering that a high interest rate and the low shares of investors is typical of developing countries, we can imagine what will be the final result that we will see on real data and on real countries, which will be this one. So here we have all the in this map we have the final cost considering all the indirect costs, so capital gains, dividends, and interest rate, and we can see how the countries of North America or Europe are the ones that managed to more or less recover their loss, the loss cost by profit shifting, or even gain thanks to the indirect cost. Instead, developing countries such as the ones in South America or Africa are the ones that are suffering a higher final cost. As we can see, a darker orange red. So thank you, everybody, for your attention, and thank you to the organizers, and I welcome your questions.
Thank you, Valeria. We would like to collect questions in the chat and answer them after we have heard all the other presentations. We will now switch to to Katharina Nicolai from the University of Mannheim, and she will present a method of quantifying base erosion and profit shifting indicators. Thank you.
Thank you, Sarah. Thank you very much for inviting me to present quantification of the OECD BEPS indicators and basically an update of the quantification the OECD did some years ago. And just to recall, so the idea of the OECD BEPS Action 11 was to provide policymakers with a better understanding of how BEPS is evolving over time and also is responding to anti-avoidance measures. And one key component of the Action 11 is the development of indicators. And these indicators should help to identify the scale and economic impact of BEPS, track changes of BEPS over time, and also monitor the effectiveness of the anti-avoidance measures. And there was proposed a dashboard of indicators. So not only one single indicator, but in total, there were 6 indicators proposed. And we can group these indicators into 3 different groups because they capture different things. So when we think about BEPS, one idea is to focus on the disconnect between real and financial activity. And this is what indicator 1 is looking at. And the OECD measures indicator 1 as the concentration of high levels of foreign direct investments relative to GDP. And then there is a set of 3 indicators looking at surprisingly low taxes or low profit measures as another signal of tax avoidance going on. And from these 3 indicators, we will focus in our paper on indicator 4, and that is the effective tax rates of large multinationals relative to the effective tax rates of non-multinationals. And effective tax rates here are measured in terms of taxes paid relative to the EBIT, so earnings before interest and taxes. And then there is a third group of indicators which focus on the specific profit shifting channel that is used. And here we will focus on indicator 5, the concentration of high levels of royalty receipts relative to R&D spending. And indicator 1 and 5 use country level data, whereas indicator 4 is a micro level, firm level indicator. Yeah. And so in brief, the research question is how the selected OECD BEPS Action 11 indicators develop over time. So the quantification of the OECD was based on data up to 2012. And in our update, we expand that time span to also include more recent data until 2016. And the data is exactly the data the OECD was using. So for the first indicator, we use the OECD foreign direct investment statistics and GDP data from the World Bank. We use unconsolidated financial data from Bureau van Dijk Orbis to compute the effective tax rates of multinationals and domestic firms for indicator 4, and for indicator 5, we take the royalty payments from the balance of payments from the World Bank and the R&D expenditure from the UNESCO Institute of Statistics. Yeah, we replicate the OECD indicators and then update the time span. And I would like to start with indicator 1. So as I said, it should reflect a disconnect between foreign direct investment and GDP. The general pattern, what we would expect is, well, somehow there is a link between market size of a country, so GDP, and the foreign direct investment received in that country. And if the foreign direct investment is much larger than GDP, the OECD is arguing that this could signal a strategy to channel funds into these low tax jurisdictions, and then that would reflect some kind of BEPS behavior. And a drawback here is that the indicator as it is defined could be driven by a few large tax havens, and also the foreign direct investment, large FDI could also reflect a dynamic investment climate, so a quickly growing location. Yeah, so let me briefly show you how countries select into the group. So here are the countries grouped into the high ratio group, and there are two variants of that indicator. So one using net FDI, this is in the top panel, and then another one using gross FDI in the lower panel. And then on the left-hand side, you see the base year 2012 that corresponds to the country selection of the OECD. And then if we use as base year 2018, this is part of our update. And it is not surprising, I think, that in these countries which have a high ratio of FDI relative to GDP, you find some prominent examples of tax haven countries or countries which have a low tax rate or preferential tax regime. So in that sense, the indicator works in a way to identify these kind of countries. And in these graphs, you can see how our estimates compare to those of the OECD. So OECD is the black line, then our estimates are in green, using the same base here, so 2012, and using 2018 to select the countries is the blue line. And until 2012, we quite nicely replicate the data of the OECD, except for the fact that we cannot find that kind of a steep increase here in 2012. And then later on, using more recent data, so between 2012 and 2018, we see kind of a decline of the net FDI indicator. Well, but at the same time, if we use a more recent base here, so we select the countries in 2018, the indicator is more or less stable. So we cannot definitely say that finding this decline is really a fact that BEPS is going down. But well, the use of the low tax countries, which were part of the high indicator group using 2012 data, these countries are getting less relevant for BEPS, maybe for FDI inflow, but the composition might have also changed. And when we look at the gross FDI indicator, there is also no decline, rather some increase still in this gross FDI indicator, signaling that well, we still see BEPS activity in the so-called conduit countries. So because if we look at gross FDI measures, that captures also countries where we see lot of income channeled through these countries. Okay, and if I turn now to the indicator 4, where the idea is to compare the effective tax rates of multinationals to effective tax rates of comparable domestic firms, so not the very small domestic ones, but those which have similar observable characteristics as multinationals. The idea is that these domestic firms have no option for profit shifting. And if I then compare the effective tax rate, the difference could capture BEPS. And the major drawback here is that the quality of the estimates I get out of here is clearly depends on how good my choice of domestic firms is and how comparable these firms really are. Yeah, and yeah, the estimation here of the OECD and also in our replication, of course, uses a regression approach. And most interesting for the insights here is the interaction of large multinationals. And if we look at the coefficients here of this reflects the comparison to the domestic firms. And here on the left-hand side, this is the indicator including also more recent years until 2016. And on the right-hand side, this is the regression, which should be as close as possible to the regression of the OECD. And but we find here that the coefficient of the OECD is 3 percentage points more negative. So we find a smaller BEPS estimate using this approach. And also what we see if we use more recent data, the difference between the effective tax rates of domestic firms and multinationals is much smaller now. So that is an indication that we see less BEPS in recent years. And here in this graph, I have the yearly estimates of the ETR differential. And again, the coefficient is negative in significance. So we find BEPS, so we find that multinationals are paying less taxes as compared to the comparable domestic firms, but the estimates are smaller compared to what has been published by the OECD. Yeah, and also we find that for more recent years, the coefficient is approaching 0, so the difference is declining. And let me turn to the indicator 5. So here we look at one specific profit shifting channel, and it has been shown that IP plays an important role, so intellectual property plays an important role to enable firms to avoid taxes and to monitor this behavior. This indicator looks at the relative share of royalty income relative to R&D expenses. And one major drawback here, of course, is that not all royalties for intangibles are linked to R&D outputs. And also, it is quite important that there's a time lag between royalty income and R&D expenditures, and R&D expenditures are highly cyclical. So it is not really clear whether this indicator really shows what it is expected to show. So if that is really a profit shifting IP strategic position of IP. Okay, and again, this is an indicator based on country level data, and before forming that indicator, countries are grouped into high and low ratio countries, and members of the high ratio group are countries which have a low corporate income tax rate or a preferential tax regime. And you find some prominent countries here like Ireland, the Netherlands, or Luxembourg. So again, in that sense, to identify some low tax jurisdictions, it somehow works, but we know that already if we look at the tax rate. And if we display and the development of the indicator over time, we see that there is some movement up and down, but no clear trend. So we cannot say that there is decline of BEPS based on this indicator. And that is despite all these anti-avoidance measures in place. And to sum up, indicator one reveals a disconnect between FDI and GDP, and the development over time signals some stable or decreasing trend for recent years. With the estimate of indicator 4, we can show that multinational firms have a lower ETR, and this difference diminishes over time and is getting closer to 0. So this might signal really some reduction in BEPS activity, and indicator 5 cannot show any reduction over time. So thank you for listening. I'm looking forward to your questions.
Thank you, Katharina. Yeah, feel free to post some questions in the chat. We will come back to them in 15 minutes after we have heard our last presentation in this session by Katarzyna Wilicka from the Utah State University. Thanks for joining us from the US, where it's early in the morning, I guess.
Yeah, it's just gone 8. Alrighty, can you all see what I'm seeing as well? Do you need it bigger, or is that fine?
Looks fine to me.
Okay.
Depends
perfect.
on how small your figures will be.
No, everything is like the size of the slide. So I'm hoping you can see it. I can make it bigger if that's not convenient. Okay, so thank you so much for including this paper in the program. I look forward to thoughts, given that this is a very new project. So any comments, absolutely welcome. This is joint work with Evgenia Dubinin and Petriansky, who are both on the call as well. So the big picture question we sort of after is thinking about the consequences of profit shifting for tax revenue structure. And I think the other 2 presentations are relevant to this, so it's nice to go after them because they kind of cover some of my motivation. So I wanted to just say that, you know, as Katharina was saying, there's a large amount of tax avoidance, especially amongst multinational. And perhaps, you know, now we've learned that extent of profit shifting maybe not has been increasing over time. But and that the estimates of tax revenue losses are quite large. And profit shifting is currently at the forefront of the political debate, especially with global minimum taxes, as I'm sure we heard in the first session. But what we don't really know as well is what are the consequences of tax avoidance practices for where governments derive their tax revenues from. And I'll explain what we mean by this as I go through the slides. So in particular, the research question we ask is how does profit shifting affect tax revenue structure? We use 2 types of quasi-experimental variation. So we motivate our study by looking at cross-country differences in profit shifting, but then we turn to Germany to look at some more causal experiments and think about changes in municipal tax rates over the 20-year time frame. 10-year time frame. So our findings, just sort of briefly, are the following. So on country level, we find that countries that have larger portion of their profits shifted out as a fraction of GDP, they have lower share of corporate tax revenue relative to overall tax revenue. But at the same time, the share of individual and VAT tax revenues are higher in those countries. And then sort of in the more causal study at the municipal level, we have 2 different identification strategies. And there we find that municipalities with higher tax rates that are home to more aggressive multinationals have a lower share of tax revenues from those firms. And that the changes in tax rates, in particular tax rates increases, a share of tax revenue derived from the tax decreases them, but only for municipalities with a large presence of aggressive multinational firms. And we use the presence of aggressive multinational firms in this context as a proxy for profit shifting to link the two results together. And so let me show you some country level correlations that serve as a motivation. So as I said, the focus is on the relationship between tax revenue structure and profit shifting. So everything we looked at is going to be as a fraction of total tax revenues. And this data comes from different sources, mostly UNU Vider, as well as IMF GFS data. And then profit shifting estimates, we use the Torslov, I guess now 2022 estimates for the 2015 through 2018 for the 40 countries they have in their sample. And as some of you may know, they use foreign affiliate statistics to show that affiliates of foreign multinationals are substantially more profitable than local firms. And then you use differences in this profitability to calculate the share of shifted profits as fraction of GDP. And that's going to be the main metric. So we're going to have sort of a profit shifted as a fraction of GDP out of each country. And then we're going to correlate this with the share of tax revenues coming from different sources, be it corporate, VAT, individual, and so on. So let me show you some graphs first, and then I'll quantify the magnitudes here. So here you can see on the horizontal axis, the share of profit shifted as a fraction of GDP at the country level. And on the vertical axis, corporate tax revenues as a fraction of total tax revenues. And you can see small but still declining negative relationship between the two. So as I said, the larger the portion of shifted profits, the lower tax revenues countries are deriving from corporate taxes, which sort of intuitively makes sense. And then sort of keeping the same metrics on the horizontal axis, but now on the vertical axis, switching to individual tax revenues, you see large positive correlations, which perhaps again is not surprising. If countries have large fraction of multinationals, they might lose a lot of corporate tax revenues, but there's some evidence that multinationals pay higher wages. So this would make sense that these countries might potentially derive more revenues from individual taxes. And then we find similarly positive relationship with VAT tax revenues. It's a little bit flatter if we're sort of thinking more about sales taxes. So clearly the countries that have VAT, for those countries, this is sort of more positive relationship. And that might perhaps indicate in some way or another that countries that lose a lot due to corporate tax avoidance might be substituting with other types of tax revenues. If we want to quantify these, so we can put coefficients on this, and then we can see statistical significance as well. It turns out that that correlation between profit shifted and corporate tax revenue share is statistically significant and indicates that 1 percentage point increase in the amount of profit shifted reduces the share of corporate tax revenues by 1.5 percentage points. And the magnitudes are large for the individual and the VAT shares, indicating a 3.5 percentage point increase in individual share of tax revenues and almost 2 percentage point increase in VAT share. One thing I want to say is that these results, at least sort of on face value, given that those are just country correlations, suggest some substitution between corporate and individual VAT revenues. But we don't find that there is a negative correlation between overall profit shifted as a percentage of GDP and overall tax revenue. That still is positive. So countries are not necessarily losing on total tax revenue, just reallocation in terms of the type of tax revenues from which they derive their tax revenues, I guess. Okay, so let me tell you a little bit about the municipal level analysis. So there are plenty of Germans on the call, so if I botch something, I am so sorry, but I've tried my best here to understand the institutional framework. So as far as I understand it, Germany's tax revenue is collected at the federal, state, and municipal level, and federal and state taxes for most of the tax revenue collected, and this is income, corporate, and VAT, and some of these taxes are redistributed from federal to state, from state up, and from federal to municipalities. And then our focus is going to be on the municipal level taxes. So Germany collects about 15% of its tax revenue there. And the two instruments that they have sort of power over are the trade tax and property tax rates. So at the municipal level, almost 40% of tax revenue comes from trade taxes, which I sort of understand as a tax on company profits, and the rate is a base rate and a municipal multiplier. And then there's the property tax, which is 14% of tax revenue at the municipal level. And that's just a tax on the value of property. And again, municipalities have control over the base rate and the municipal multiplier. And the rest is apportioned from federal and state tax revenues. And then municipalities have to apportion 10% of their tax revenues back to state and federal government. But what is crucial for our identification strategy here is that municipalities have control over trade and property tax rates, and then they can use their revenues as well. So we're going to take the advantage of that structure and the variation in the tax rates at the municipal level. And so we're going to take revenue structure from the German Office for Statistics. So our data set is at the municipal level. So Germany has over 11,000 municipalities, and we track them over the 10-year time period from 2008 through 2019. And we have all the sort of components that we would expect. We have trade tax, property tax, and total tax revenue at the municipal level. And then for tax avoidance here, so sort of thinking about the relationship between the revenue structure and tax avoidance, we're going to measure tax avoidance using firm level data from Orbis that Katerina also was using. And we're going to obtain location of over almost 4,000 million German firms. And we're going to match the address of each of those firms to municipalities using GIS software. We have no perfect match because some of the addresses are not that great, but 85% of companies in Orbis, we can actually drop a pin down into the municipality in which they're located. And then for each firm, we're going to identify their ownership status. So we want to distinguish between domestic and multinational firms. And then within multinationals, we can also distinguish between those headquartered in Germany and outside. And then we're going to classify multinationals into what we call more aggressive, i.e. those with tax havens in their structure and those not. Of course, this definition is up for debate. You know, we can try to think about other firm level proxies for firm avoidance, but we start with this in this preliminary version. What we find is that we have approximately 20,000 subsidiaries of multinational firms across all German municipalities, 8,000 of which belong to what we call more aggressive multinationals, i.e. there's some tax haven in their structure. But as I said, our analysis here is at the municipal level. So we're going to collapse this firm level data at the municipal level. And then the tax avoidance in this context is going to be the share of aggressive multinationals. This is the share of all firms in each municipality. And again, we tried various definitions. I'm just going to show you one today. So to identify the relationship between tax avoidance and revenue structure at the municipal level, we're going to use the following variation. So we're going to be changes in differences in tax rates across municipalities. As I say, they all set their own tax rates. So we're going to look at the variation in those as well as changes over time. And then the second piece is the difference in the share of aggressive multinationals across municipalities, right? Each municipality will have a different share here. So this means that there are two sets of results, and I'll flash them at you very briefly. The first one, the one that relies on cross-sectional variations, estimates the model in which on the left-hand side, you've got a share of particular tax revenues in all tax revenues, as well as logs of both types, so property and trade tax revenues. And then on the right, you've got the share of multinationals in each municipality, the tax rate, and then the interaction between the two. And we're going to be interested in the interaction. So the coefficient is going to tell us the difference in the tax revenue structure between municipalities with different tax rates and depending on the share of aggressive multinationals. And then we're going to have event study evidence. So we're going to say what happens after there's an increase in tax rates, since most of the municipality tax changes over the time period we have in our data are actually increases in tax rates. So we're just going to focus on those. And then there, as I said, there are three outcomes. Here, share of trade tax revenues in all tax revenues. So we're going to look at mostly changes in trade taxes, given that they're taxes on corporate profits, but I'll show you some stuff with property tax as well. And then just the trade and property tax revenues on their own and total tax revenue to have sort of a complete picture. So just on the variation across municipalities. So this is a number of aggressive multinationals across municipalities. So I'm flashing this to give you an idea of a variation. Okay, so you can see in the darker shades, you've got basically municipalities that contain more and more aggressive multinationals. And then this is the trade tax multipliers. So just something to keep in mind that those two variations are very different. And then those are the changes in the trade tax multipliers. So the tax rate changes that we're going to use, and some municipalities increase their tax rates multiple times. Okay, so first on the cross-sectional variation. So panel A is what we're focused on, and panel B is a placebo experiment. In panel A, when we look at the share of aggressive multinationals at the municipality level, we find that in municipalities that have higher tax rates and more aggressive multinationals, the share of trade tax revenue to total tax revenue is actually lower in those. And that is driven by the decline in column 2 for trade tax revenues. Nothing happens to property tax revenues. And because of this, consequently, there's lower overall tax revenues as well. But that is not a function of multinational presence, which is what panel B is about. So when we just look at the share of multinational firms, we find absolutely nothing at the municipal level. Okay, so this is about presence of aggressive multinationals that perhaps have the ability to shift profit. In terms of an event study, we see very similar patterns, so they're consistent. Again, the outcome is share of trade tax and all tax revenues. So following a tax rate increase, we can see a decline in the share of trade tax revenues, but only for municipalities that host more aggressive multinationals. So this is the, call it triple interaction effect here, okay? And if you look at components, this is trade tax again, so you can see a large decline in trade taxes, no changes in property taxes, and again, consequently, a decline in total tax revenues as well. So the cross-sectional variation and the event study variation are very similar in terms of their results. And then the natural question that follows is, well, okay, so municipalities are losing their tax revenues if they're host to more aggressive multinationals. So what happens to expenditures, GDP, and debt? So this is very preliminary. Apologies to Ron, you haven't seen it, but here's what I made yesterday. So you get to see it. We don't see anything for expenditures or GDP or total debt. Those time series seem to be pretty flat to me. So we're still thinking about what to do with this result and what this really means. And then I just want to leave you with a few key takeaways. So sort of the main high-level overview points from this paper are first that the ability of firms to shift profits is strongly related to tax revenue structure. Countries that are most exposed to profit shifting, multinationals, choose to rely more on indirect taxes, losing revenues from corporate taxes, but not necessarily overall revenues. And at the municipal level, profit shifting is causally linked with lower revenue shares coming from corporations through trade tax. And then when we want to think about policy implications, I guess the first one is that we show that governments raise revenues in the absence of corporate tax revenues from multinationals, and which groups bear the burden of tax? Not paid by multinationals, if you want to think about this in that way. And then if we think that indirect taxes are more aggressive, this perhaps may amplify inequalities, as the first presentation and the second session was talking about. And so in a sense, on the municipal level, then presence of tax aggressive firms reduces local capacity to collect tax revenues from those firms as well. And thank you so much for your attention, and any thoughts are welcome, given that this is very preliminary.
Thank you very much. And we have invited Ron Davies from the University College Dublin to comment on the last presentations. Thank you very much, John. Ron, for joining us.
Great. So my name is Ron Davies. I'm at University College Dublin. And so thanks for the chance to read all 3 papers and sort of sit here and try to think about how I'm supposed to summarize 3 papers in 5 minutes. And I guess in a way, this is a good thing because, what a time to be alive as a tax economist. What we do is actually headline news now. People want to know what we think when we go to dinner parties. And what do people think? Well, they think the big multinationals don't pay their fair share of taxes. They think the 1% don't pay their fair share of taxes. And they're kind of angry about it. And they're happy to rant. And I can rant with them. And why does this matter? Well, there's the whole idea of lost revenues. Yeah, I mean, that's part of why people are upset. That the big successful companies aren't paying as much as you think they should. But sort of there's this other aspect of it that it kind of forces the rest of us to cover for them. So either if you want to think about what, Valeria had in her model, where, it was, okay, the governments are losing revenues, they've got to go out and borrow to cover that hole. Or whether you want to think about what Kat was talking about, they've got to go get that money from somebody else. And as a result, this is going to increase inequality. This has come up several times today because, if the rich don't pay taxes and get to be even richer as a result, and we all have to cough up money in order to cover for that, that just widens that gap. And so this is why people are really upset. And this is why this is really newsworthy at the moment, when we're not having World War III or a pandemic or anything. So, then there are a couple of questions we want to sort of think about. So first off, how big is this activity? And is it getting any better over time, in particular, as more and more scrutiny has come on it, in political circles and the wider public? And so Valeria sort of talked about this a little bit. Maybe it's not as big as we thought because that money goes somewhere. So I live in Dublin. Apple and Google and Facebook and everybody is about 5-6 kilometers that way. It's not like they have a giant mattress in Ireland and they stuff the money in there and nothing happens with it. It goes somewhere else. And one of the ways it might pop up is through increased dividend payouts or capital gains, and those get taxed as well. And so if this money then is recycling back in a different format, that might generate tax revenues. Then it might actually offset some of the things that you might be worried about. But then we get into what Katarina was talking about is, how is this changing over time? Is it getting any better? Her results are kind of like, it's not obvious it's getting better. Maybe it's not getting much worse, but maybe it was really harsh to start with. And so it sort of depends on, what yardstick you want to use and what it's made of, how you go about implementing that. So, is there profit shifting? Everybody on this call agrees. Yes, it's happening. Yes, it's probably a lot of money. It's not clear it's getting better anytime soon, although things like the global minimum tax might help to some degree. Then we get to sort of the other aspect of it, which is it's contributing to inequality. Does it look like it's increasing inequality? First answer, again, coming from Valeria, is like, yeah, it seems like it's doing it. Why in their context is it increasing inequality? Because where the owners of the profit shifting firms are is not evenly distributed across the globe. Certain countries have a lot of these people, they're getting a lot of those dividends back, and they're still getting that tax revenue off that to help plug at least some of their lost revenues. The other aspect, and this one I thought was very clever, it had never occurred to me, is, okay, if there's this fiscal hole that you got to fill, you go out and you try to borrow that somewhere, the ability to do that varies a lot across countries. And so again, you're going to have sort of inequalities perhaps within a country, those that own dividends or that own shares, those that don't, as well as across countries. And then we get to what sort of Kat was talking about, which is like, okay, if your governments aren't getting the money from corporate revenues, do they look like they're getting it from somewhere else? And the answer seems again to be yes. The share of revenues coming from corporations is lower where shifters live. And depending on the specification, it looks like they might be clawing that money back either through personal income taxes or through value-added taxes. So, I'm supposed to be a discussant, so I feel like I should say something sort of to push each paper forward. And there are little things that I could quibble about, but, what I really like about Valeria's paper is thinking about, okay, where does money go? Where else might it show up? And to self-promote a little bit, I have a brand new paper with some co-authors where we use employer-employee match data from Norway. And what we find is that the firms that profit shift pay higher wages, in particular to the people at the top. And those people pay higher income taxes. That helps offset some of the lost revenues, but only about 3% is our back of the envelope calculation. But where else does this money go? Does it perhaps increase capital investments? Does it increase R&D? There's increasing evidence to show that when taxes go up, R&D spending goes down. Well, maybe we should expect the same thing to be happening in terms of the use of tax havens. And so, those are other things that in a general equilibrium sort of medium long range setup may actually affect the net impact of profit shifting. And again, if this R&D is being done in the rich countries and they continue to advance, that could leave the developing countries even further behind. And then what do these real changes mean? So there's some work by Julien Martin, Matt Parenti, and Farid Tubal, where they're looking at US data, and they find that profit shifting seems to increase the concentration in a market. It gives these firms an undue advantage, which from a legal basis is the EU's entire point when it comes to the Apple Ireland case. And so, you know, if you've got changes in market structure, if you've got changes in wages, if you've got changes in R&D and therefore survival rates across firms, all of these may contribute to the inequalities that aren't what is at people's forefront, which is, oh, they pay less in tax than I think they should. But all of these things probably matter quite a bit as well. Now, moving over to Katarina's paper, you know, what she's trying to do is she's trying to talk about how these measures of the extent of profit shifting compare, in particular, as we update from what the OECD gave us in the beginning. And sort of the big takeaway for me was these OECD indicators are nice because they're easy, but they're not very good at sort of describing what's going on in a lot of ways. And part of that is probably because the players keep changing. So, you know, right here in table 2, this is sort of the countries that have a lot of FDI relative to their GDP in 2012 when the OECD did it, and then 2018 when she and her co-authors did. And one of the things that jumped out at me is there's a lot of change here. Only about half the countries in 2018 are there in 2012. And some of the ones in 2018, like Mongolia, I don't think anyone's hiding profits in Mongolia. I think this is, anytime you use a share, FDI over GDP, if GDP is really low, which probably kind of is in Mongolia, you know, that's going to give you some things that pop out a little bit weird like that. One of the things I would encourage you to do is just use tax havens. You know, we all sort of have a reasonable idea who the tax havens are. And every time I call Ireland a tax haven, I get a call from revenue and they're not happy about it, but we are. And that's a fairly stable list, I think, over time. But going to sort of like the tax difference between a multinational or a profit shifter and a purely domestic firm, it sort of depends on whether you use the regression analysis where it looks like things are getting a bit better, or whether you're using the matching where it seems like it's pretty steady over time. Maybe that's because sort of who the players are, who you're being matched with, it's easier to match in certain periods of time than other periods of time. You know, if we're seeing a general divergence between the multinationals who, because of their lower tax rate, can invest in more R&D, then maybe just the matching technology is getting harder and harder over time. And so, you know, it's an admirable effort, but what it really points out is it's really hard. But what's clear from it is it doesn't look like it's getting better anytime soon. And then we come around to what Kat was talking about. And so the idea is that, like, okay, if I've got a lot of these aggressive multinationals, maybe I'm just going to rely less on corporate taxes and have to go elsewhere. And so she presents some estimates that really sort of point towards this. But again, like, shares are always tough because if you hold everything constant, nobody changes anything, but suddenly half the corporate base disappears for some reason, gets swallowed up by a monster. Well, the corporate share has to fall by definition. By definition, some other share has to go up. So there's almost just a mechanical change here that kind of drives it. But what I think you're really talking about is the base. That, you know, it's the corporate tax base when you've got a lot of these aggressive multinationals is more elastic, more responsive to the tax rate. And therefore they move out very quickly. And that then forces the government to rethink how it balances across different things. But that leads to the last one, which is if it's going to rebalance, it's probably also going to rebalance in the rate it applies to these different bases, the personal income tax rate, that kind of thing. So, like, you know, for Ireland, we have a lot of aggressive multinationals. Our corporate tax rate is, let's just call it low, but my personal income tax rate is, let's just call it really freaking high. You know, and that's probably part of it. And that's the unfair part that gets people really worked up. Because it's not that so much that, you know, okay, they're not paying that much, but it's I have to cover for them. And so in the regressions with the municipalities, you're controlling for the tax rate when looking at the share. But to me, the tax rate is almost the thing you want to think about, because changes in that tax rate seem if you've got a lot of the profit shifting multinationals, seems to be the part that kind of is interesting. And that thing kind of goes back to the beginning of today's session, where Valeria is talking about the idea that, like, okay, the money comes in through higher dividends. Well, there are tax rates on that. And so thinking about progressive income taxes, the taxes on the super wealthy versus regular people, and all of those kind of come back together. And so when you put it all together, it's really an interesting session, because it's talking about the fact that, you know, this profit shifting is going on. It doesn't seem like it's getting any better. It is complex, but what we're starting to unpack is, what does it mean? Not just document how much money is being moved and where it's going, but what does it mean for society? And that unfairness idea, which is why this is really a hot topic at the moment. Thank you.
Thank you very much, Ron. I think there's a lot to be commented, probably by the speakers. Who would like to start?
So, hi. Thank you very much, Ron. This was very interesting, and yeah, I really think that this would be a very important further step for understanding what happens after those capital gains and dividends are indeed taxed. And also, yeah, in the case of Norway, thank you for pointing it out. And I really thank you for the hints and everything. And indeed, in the case of Norway, it is a particular case because Norway also owns, is the state itself that owns a lot of shares. So basically, this is a particular case in which those profits that comes from tax havens are used directly are collected directly from the state. So they have basically a tax of the 100% on them, which is a big advantage, and that's why Norway manages to have these high gain with respect to the other countries. And yeah, also, but this is not valid for every country. And understanding what happens when those profits are distributed to shareholders, so to the richest part of population. What happens after that is really interesting. Should be, and surely we could have a gain for the states and for the countries, but also probably this could have a consequence on the inequality inside the countries, not only the inequality between countries, as we have seen in our paper. But yes, there's a lot to understand, a lot more to understand. Thank you.
Yeah, maybe I can continue. So thank you for the comment. And yeah, I have been extremely brief on the potential disadvantages of these three indicators. So they, especially the indicators using this country level data and the pre-selected list of countries, they are really hard to interpret because there are so many influences other than BEPS that could drive up and down these indicators. So you are absolutely correct to stress that point. And with respect to the composition of the countries in that list, we will definitely try to well, use just the tax haven list and to see what comes out of that. Yeah, and I think from the indicators that I presented, the most reliable, I would say, would be the one where we use microdata and do that comparison between the domestic and multinational firms. But still here, depending on the country we are looking at, there are countries where we can find domestic firms which are quite similar to the multinationals, and then there are other countries where that matching also does not work that properly. So maybe here we should maybe stick to countries where the matching works best. Thank you.
I guess my turn. Thanks, Ron. I have 2 points. I think your suggestions are spot on. So I like the idea of looking at tax rates. My only concern perhaps is that at the municipality level, because the only two that they can really control are like the trade tax, so the corporate one, and then the property tax, we won't be able to do like the inequality angle, right? Because they don't really control the individual tax rates, but we can look at it at the country level and I guess say like there's some suggestive evidence. And then the second is clarification. So you don't like the idea of looking at the shares of tax revenue as an outcome variable, because we also looked at like the tax revenue as a share of GDP, but I'm less fond of this one over the as a share of total tax revenue. So I just wanted to clarify that.
Yeah, I mean, for me, it's a share. You know, if there are two pots, A and B, A goes down, B's got to go up. And so at the very least, I feel like those should be estimated as like, I don't know, seemingly unrelated regressions or something like that. So,
yeah, I think
but, you know, it's that mechanical aspect of it.
Mhm.
But, you know, but even still, like, you know, people complain about the shares, but I think everyone here talks less about the shares and more about the amount of money, the revenues that get raised. And so, yeah, I don't know what to do with it, but I don't have to,
like the
because it's your
results are just
paper.
you know what, the results are the same, right? Whether you do it as a share of tax revenue or as a share of GDP, you still got the negative and positive correlations in the right direction. So I think neither here nor there, but I take that point. Yeah, sure, some people might be offended by that. Thanks.
There is a question from the audience, from Thomas. Do you want to ask yourself, or should I read it out? Maybe you can ask yourself, given that there are not so many people.
Yeah, sure. I think if I ask directly, it's a little bit more efficient. So very nice results. Thank you. And all of the papers, I really enjoyed watching them. Basically, my question to Kat is on the debt, GDP, and expenditure results. I don't know if you will get something out of this, but I was not sure if these are measured at the municipality level, firstly, and then could it be that the actual economic effects are small of the tax changes, so they don't appear in the GDP, debt, and other expenditures? And I would suppose that at the time, I mean, probably it's also, if we're looking at the 2010s period, then maybe it's a time of consolidation, economic consolidation as well. So raising more revenue doesn't necessarily mean that they do something with it, but probably they store it as cash reserves as well. So that's my thoughts.
Yeah, so so there are like three. So let me go one by one. So the first one is, yes, the data is mostly at the municipal level. We don't have as good GDP data on the municipality level, so you kind of make do with much smaller samples. So they aren't like perfect, those results by any means, but all of it is at the municipality level. The second thing, that the effect could be small. This is why we don't see anything. In a sense, like, you can think of it as being reassuring or not, right? So on one hand, if you think that municipalities that have more aggressive multinationals really lose tax revenues, perhaps the question is, do they compensate with something else? But it's true, if it's a period of consolidation, maybe they don't, right? And so maybe we wouldn't expect any effect on expenditure. So this is purely explanatory. We don't have any hypothesis here, but there are two sides of the coin. If as the government I'm losing revenues, perhaps I want to substitute with something else. And then if I don't substitute with something else, or if I don't reduce my expenditures, then the next question is, well, does it affect my GDP? Or perhaps then I borrow to be able to afford anything if I don't get revenues and I don't cut my expenditures, right? This is sort of where this took us. I agree with you that the effect might be economically too small to actually reflect in the GDP, but I would at least expect something for expenditures. And the fact that we don't find anything led us to think maybe they just borrow more, but they also don't, right? So this is a bit of a puzzle to me, and we're still trying to figure out like what's going on in this. I hope that answers all the points that you made.
Yeah, sure. Thank you very much.
And there's another question, Benny Bosnan.
Hi, thank you. I have two questions actually for Katharina, both of them. So regarding the indicators, the first one is, so if you observe that the development over time, the overall levels of some of the indicators look similar, so like nothing is happening. But I was wondering, at least with some of these indicators, maybe you are able to explore the second moments of that. So perhaps the case is that the overall level is similar, but it's now more concentrated across within the firms, right? So the companies that are responsible for these indicators are perhaps fewer than before, but the overall level stays the same. So I was wondering whether that might be something that you could explore more with at least some of the microdata-based indicators. And also a bit to Ron's point that about the Mongolia appearing there, you know, I feel like there are several types of indicators, and the one that you were showing are mostly about activity. So what we observe in the data, what is happening. But there is also another set of indicators of tax havens, and that is on the opportunities that these tax havens offer. And I feel like, you know, with some of these countries at least, there are different reasons for the high intensity or activity indicators that we observe. And perhaps they cannot be explained by opportunities because the opportunities are not offered by these jurisdictions. So I would argue that a good indicator would be a combination of these two, of the opportunities type of indicator and the activity type of indicator. So the activity when it's high, and at the same time there are opportunities. So there is a good reason to think that this activity is in that place because of these opportunities. That's the tax havens that are sort of important. Yeah. That contribute most to the problem, I'd say. I don't know if you've thought about that, or yeah, if that's helpful. Anyway.
Yeah, actually, in the current version of the paper, we are mostly stick as close as possible to the description of the OECD, how they conceive the indicator, and there they had this kind of arbitrary cutoff at I think 50. For the 50% for the high ratio countries, and yeah, we're not well reflecting a choice based on these arguments whether the opportunities are. It's just mechanically dividing the overall country sample into the high and low, and the cutoff is at 50. Yeah. But if we are now revising the paper, I think it really makes sense, well, to incorporate these comments and to think about how could we learn more from the indicators and maybe adjust the definition. Right. Thank you very much.
Apparently my mic is not working well. I can't do anything about it at the moment. Sorry, if somebody else has a question to ask. Okay, otherwise I will try. I have a question on the ETRs to Katharina, because I was surprised, if I understood your results correctly, the ETRs of the multinational firms and the domestic firms are converging, or the gap is not as big as we would expect. And I was wondering if it's related to your tax base, if it's the financial, if I understand it correctly, is it the financial profits of the affiliate of the multinational group? So might it be that some of the profits have already been shifted so that the ETR looks normal? But if you could somehow compare to the group ETR, this would look very different.
I have to think about that. Actually, at the moment, I'm not sure that if I understood the question.
Sorry. Because if you have I don't know, if you have the financial profits of an affiliate of a multinational group, and then you compare the tax payments of this affiliate to its profits, let's say in Germany, the ETR might not look especially low if the profits have already been shifted and therefore not included in the financial profits of the affiliate. That was what I was wondering.
Yeah. Yeah, so I know what you mean, yeah.
I think it's a problem we have in most of the data, I guess.
Yeah. So, yeah, actually, yeah, but this would also, well, I think this argument also holds for the numbers presented by the OECD, and there the coefficients are much more negative. So I think it cannot explain that we now find an estimate close to zero, but still it highlights some additional aspect that we should definitely discuss, whether the ETR is the correct measure or whether we should kind of use log profits or something where we do not divide the tax payment by the profits, right? That is your point, that we divide the tax payment by the profit. That could be problematic. Yeah.
I don't know how I have the same problem when I use CBCR data. Probably when I have a low global ETR of the MNE, but maybe the ETR in a high tax country is not extremely low. Yeah, it's more a question. I don't know how to do it. But there's another comment. Yes,
So I just thought about something as you guys are discussing, Katarina. So I mean, a related but not quite related question. So you and maybe I missed it. So you estimate the gap in the ETR, so notwithstanding the question about the base of it, but more about what is this decline in the gap driven by? So you know that there's some work from US saying that perhaps the ETRs for domestic firms are falling through. And so my question is sort of, what's driving the decline in the gap? Is it changes in ETRs for multinationals or for domestic firms?
Yeah, actually, that is something I can look up.
Yeah, I think that's a very simple thing. It's just interesting, right? Because if you talk about the decline in the gap, then it's interesting to say okay, well, who is actually contributing to that decline?
And if nobody has other questions, I have another for Valeria, maybe on the if we assume that the shifted profits are distributed to the shareholder, and then I was wondering how you assess the tax payments or the potential tax payments of those shareholders. And because we have also, they are very concentrated at the top, maybe those shareholders also use offshore structure, so there might be a leak, like relatively big leak in this indirect effects. I was wondering how you assess those indirect channels.
Sorry, I don't hear you completely well. I'm sorry. Yeah, if you can repeat or write.
Yeah, sure, Sarah. if I understood, Sarah, your question correctly, you were asking that, so we're considering taxation at the shareholder level. So once the profits are paid out to shareholders, and your argument is that these are concentrated at the top. So it's rich people owning multinationals. But your question was about which tax rate we're using, if it's the top rate, or what was your question, Sarah? I also didn't understand the rest of it. If somebody else has a question in the meantime, Sarah can type it in the chat. Please go ahead.
While we're on that topic, one of the questions I was wondering is, a lot of tax treaties specify particular tax rates for a treaty partner when it's a dividend payout, and it can even vary according to how much it is held. So, you know, I don't know whether you went through and used sort of the statutory rate, like the top tax, or whether you went through and sort of adjusted it for the treaty specific rates.
Okay, so how we calculated the tax on the capital gains and dividends, right? Is that your questions? How we is that correct, Ron?
Well, so part of what I was thinking about is like, okay, you send money to Ireland, and then Ireland's going to pay out a dividend back to you. The Irish government can withhold part of that. So they can withhold part of that dividend payment and using a withholding tax. Now those rates vary country by country, even though it's Ireland sending it by the network of tax treaties. So like I know there's stuff like Vent Reet and Lejour where they look at the treaties, and you know certain countries are really good in terms of being a node in sending from A to B to C because of the treaty shopping aspects that are available. And so I don't know whether were you taking tax treaties into account when calculating that tax rate?
So basically what we do is we know thanks to the metrics, and we know how much of those profits are redistributed, right? And are, for example, I don't know, they are redistributed to the shareholders in Germany. We know the amount. And we assumed that from the OECD report, that those profits are divided on 30% on dividends and 70% on capital gains. So knowing that, we also know always from OECD reports data, from OECD data, that we know the tax on capital gains and dividends of all the countries in OECD, for the OECD countries. For the other ones, we use the IBFM data. That's how we calculated it. I hope this answers your question.
Yes, thank you. This has also partially answered my question. I'm back under a different name. Are there other questions or comments from the audience? Well, then maybe we're finished for today. I think we had a very interesting discussion on tax avoidance, how to measure it, and potential effects. First round, second round. I'm looking forward to hearing more and reading your papers in more detail. Thanks a lot for joining us, and I'm looking forward to seeing you in future events. Thanks a lot to Peter, Miroslav, to all the speakers and commentators. See you soon. And you can find the replay of the event on our website.
Thanks, everyone. Have a good day.
Goodbye.